5 secrets to interest-free funding in 2026. In 2026, the banks are not looking for people with money, but those who know how to manipulate the new credit algorithm, which is exactly why business owners are still asking, how are ordinary people walking away with more than $50,000 in funding without paying a single dollar in interest? What is the one funding method that big banks have used for decades but never taught you? And why are thousands of entrepreneurs scaling their business right now without ever taking a traditional loan? In this video, I'm breaking down the 5 secrets to interest-free funding in 2026. Make sure you stay until the end, because the secret at number 4 can unlock more capital than anything else on this list. Let's get into it. Number 1. The 0% APR credit stacking strategy. This is the secret I see most people overlook, but you shouldn't anymore. Right now, major credit issuers are offering new credit cards with 0% introductory APR periods up to 21 months. That means you can borrow money, put it to work, and pay 0 interest, as long as you pay it off before that window closes though. But here's where it gets interesting. This is not just about getting one card. The strategy is called credit stacking, and it works like this. You apply for multiple 0% APR cards within a concentrated window of time, so that the hard inquiries are on your credit report and grouped together rather than spread out. Done correctly, you can end up with a combined credit line of $50,000, or sometimes well into 6 figures, all at 0% interest. Smart entrepreneurs use that window to fund inventory, marketing, equipment, and operations. Regular people use it to cover education, home improvements, or even seed money for a side business. They generate income or savings during the 21-month window, then pay off the balance before the promotion rate expires. Now, here's the part most people skip over, and it can hurt them badly. If you spend without a repayment plan and that promotional window closes before you've cleared the balance, some cards will backcharge interest on the entire original balance. Let me give you an example. Say you borrowed $20,000 and paid off $18,000. Suddenly, you owe interest on the full $20,000 from day one. On the full $20,000 from day one. That's not a flaw in the strategy, but a trap built into it. So how do you maneuver it? The secret is simple. Only stack what you can realistically repay within the 0% window. Treat it like a short-term interest-free loan, because that's exactly what it is. Which brings us to the next secret. And this one is for anyone who already has some income coming in. Number 2, revenue-based financing. Revenue-based financing is one of the most powerful funding tools available in 2026, and most people have never heard of it. Here's how it works. An investor or financing company gives you a lump sum of capital upfront. Instead of charging you a fixed interest rate, they take a small percentage of your monthly revenue until the agreed amount is repaid. There's no 20% APR or compounding interest. You don't even have a fixed monthly payment. That ignores whether your business has a good month or a terrible one. The repayment is flexible by design. If there's no revenue, you pay nothing. However, if your revenue is strong, you pay more and clear the balance faster. A hypothetical scenario looks like this. You receive $50,000 and you agree to repay $65,000 through a percentage of a monthly revenue. That's a flat multiplier with no interest rate attached. Now, here's the controversial reality that most RBF companies won't advertise. If you calculate the effective APR on a slow repayment timeline, the cost can actually exceed what a traditional bank loan would have charged. Some analysts have pointed this out, and they're not wrong. But here's what those analysts missed. The flexibility is the value. A bank loan charges you 10%, whether your business makes $5,000 that month or $50,000. Meanwhile, RBF scales with you. For businesses with seasonal revenue, inconsistent months, or early-stage unpredictability, that flexibility is worth more than the rate difference. Also, RBF works best if you already have revenue coming in through e-commerce stores, service businesses, SaaS products, and freelancing with recurring clients. Apparently, if you have revenue, you have leverage. And leverage is how you fund growth without giving a bank the power to dictate your repayment schedule. Up next is a secret that will surprise you, and it's been sitting in plain sight the entire time. Number 3. CDFI loans and government-backed zero-interest programs. Community Development Financial Institutions are nonprofit lenders certified by the U.S. Treasury. Their mission is to provide affordable capital to people and communities that traditional banks ignore. While Chase and Amex might charge 15 to 20%, a CDFI will give a local business owner $50K at near zero cost because their profit is the 10 jobs you create in that neighborhood. Organizations like Axion Opportunity Fund and local CDFI networks across the country have disbursed billions of dollars in affordable funding. And unlike a bank, they're not in the business of maximizing profit off your interest payments. They exist to get capital into the hands of people who need it. On top of CDFIs, federal and state government programs continued to expand in 2026. The SBA's microloan program offers loans up to $50,000 through nonprofit intermediary lenders, many of whom offer below-market rates. What most people don't know about these programs is that they are dramatically underutilized. The funding exists, and applications are open. But because the average person assumes they won't qualify or the process is too complicated, the money sits unclaimed. The qualification requirements are often far more flexible than those of a traditional bank. Credit score minimums are lower, and collateral requirements are sometimes non-existent. What these lenders care about most is your plan, character, and ability to demonstrate that the money will be put to productive use. If you've been told no by a bank, a CDFI may still say yes, charge you far less for the privilege. This leads us to the secret the startup world has used for years, while everyone else was filling out bank loan applications. Meanwhile, if this video is giving you more value than your local bank ever has, go ahead and hit that like button and subscribe. Let's get back to the countdown. Number 4. Safe Notes. A safe note is an acronym that stands for Simple Agreement for Future Equity. Don't allow the terms to scare you. It's just a funding instrument where an investor gives you money today and in return receives equity in your company at a future point. This happens when you raise a large funding round or sell the business. There's no interest rate, monthly payment, or debt on your balance sheet. Platforms like Republic, WeFunder, and Start Engine have opened this up far beyond Silicon Valley. Regular people with real businesses are raising $25,000 to $500,000 from communities of small investors. All of it is interest-free without a single bank involved. Now, here's the part of this conversation that almost nobody wants to have. Safe notes are not free money. The cost is equity. You're giving away a percentage of ownership in your business. If your company is worth $2 million 5 years from now, the investor who gave you $30,000 today is holding something worth far more than that. So the question you have to honestly ask yourself is this: which is more expensive, paying 20% interest to a bank and keeping 100% of your company, or paying zero interest to an investor and giving up 5% of your equity? There's no universal answer. It depends entirely on how valuable you believe your company will become. That is exactly why I wrote Credit Rewrite 800, the 800 Plus system. It gives you the formulas to calculate your true cost of capital so you can stop guessing and start scaling. I put the link in the description below for those of you ready to stop playing small. Now, that leads us directly to the last secret on this list, where we go from private investor banks to an interest-free lender on the planet. Number 5, grant funding. I saved this one for last because it's the most misunderstood, and that misunderstanding is costing people money. A grant is not a loan. There is no interest because there is no repayment. You receive the money, use it for its intended purpose, and that's it. In 2026, grant funding is still available, but with high competition. Federal agencies, state governments, foundations, and major corporations all run active grant programs. These grants target small business owners, women entrepreneurs, minority founders, and individuals in specific industries. We have the Amber Grant that awards $30,000 every month to a woman-owned business. There's the NSF Fund Innovation Grants for science and technology startups, and that list barely scratches the surface. Unfortunately, a lot of people think grants ain't for them. That's why the application pools are less competitive than you think. Thousands of dollars in grant funding go unclaimed every single year because people assume they don't qualify before they even try. Yes, we know that the application process takes time. Some grants require a business plan, project proposals, or financial documentation. But here's the comparison I want you to sit with. You could spend 3 hours filling out a grant application and receive $10,000 you'd never have to pay back. Or you could take a $10,000 loan at 20% APR and spend the next 2 years repaying back $12,000. The choice is up to you. So, drop a comment below and tell me which of these 5 secrets you're going after first. Remember to hit the like button and subscribe if you haven't already. And if you want to go even deeper, watch our next video on how to increase your credit score as an immigrant in the U.S. I'll see you there. Wait. For more helpful info, don't forget to check the description below.